Financial analysis of Air Canada and shoppers. First, introduction. Hello everyone, my name is Mia Zhang and I am a CFA. I was tasked by my boss to provide you with a financial analysis and report on two companies, Air Canada and Shoppers. Even if the two companies belong to different industries, we can analyze which company or even which industry is more suitable and better for investment based on the current economic situation and data. Investing in different industries provides a risk reduction exposure to various market cycles, opportunity for growth, income stability, and access to a wide range of investment opportunities. Part 2 Decision. Air Canada and Shoppers are both companies with strong roots in Canada, and they are basically open to Canadians. Many industries have changed significantly during the COVID. For example, the pharmaceutical industry, which has always been stable, it has been great growth. The transportation industry, which has always been very risky, but is at the low point, but will certainly grow more when the economy returns, perhaps doubling its profits. So I think both companies are investable. If you want to continue to invest conservatively, choose Shoppers, and if you want to make more profit in the future, then choose Air Canada. So third part, justification. Liquidity reasons. The current ratio of both companies are all lower than 2, but Air Canada has higher value than Shoppers. Air Canada has the highest current ratio in 2021, which was 1.45, and it is here. Since the ideal value of 2 is the data before COVID, we cannot assume that both companies' debit ratios are substandard. Because of this, therefore, the current ratio of both companies are at least included in the normal range. Also, from the graph beside, it is not hard to see that both companies' current ratios are higher than the industry average for these 4 years here. And just a reminder, old industry number 1 is for Air Canada and industry number 2 is for Shoppers. For quick ratios, the ideal number is 1. The Air Canada company has the highest value of 1.42 in 2021, and Shoppers is 0.86 in 2019. Until now, Air Canada still has a higher ratio than Shoppers. Both of them are not only very close to the ideal number, but also way higher than their industry average. The reason why Air Canada's quick ratio is higher than Shoppers is not only because the industry average is higher, but also um, because Air Canada is a transportation company. Regardless of the situation, the money earned by traffic in any area is a channel that responds to the economic situation, just like the price of oil. It also means that no matter what the time, transportation is the basis of the um, world economy and the country. The pharmaceutical industry is important, but if there's not enough demand for products and transportation, then the industry's quick ratio and current ratio will naturally become low. So that causes Air Canada's quick ratio to be higher than Shoppers. Compared to Shoppers, Air Canada's inventory ratio is way higher, which means Air Canada is better use of cash. Also means the company doesn't have to tie up the loss of cash in goods to generate a loss of sales. And there are some reasons for this situation. First, nature of the business. Second, inventory management strategy. Third, seasonal variations. And fourth, product perishability. And fifth, supply chain complexity. If you want to see the explanation of those 5 points, then just check my worksheet. Borrowing capacity reasons. First of all, the ideal range for debit ratio is less than 50%, and equity ratio is greater than 50%. For Air Canada, it has an average debit ratio of 2.63% and average equity ratio of 4.14%. For shoppers, it has an average debit ratio of 97.13% and an average equity ratio of 2.87%. From above, it is not hard to see that both companies don't have enough good data on debit and equity ratio. The debit ratio for Air Canada is qualified, but the equity ratio is not. So Air Canada doesn't have the issue to be insolvent, but has an issue to be staying well. For shoppers, it has an extremely high debit ratio, which means it has a substantial amount of debit in its capital structure, which can have implications for its financial stability, profitability, and future growth prospects. I know this is a long graph, but I have to go through. And for return on net sales, both companies are way lower than the industry average. As you can see in the graph here. Air Canada is better than Shoppers because the higher is better. From the graph, it's easy to see that Air Canada has very stable data, which also reflects that it's very good at controlling revenue and output. Having a stable value of return on net sales provides a financial stability, instills investor confidence, and enables the effective strategic planning and miti- mitigates financial risks. It ensures the constant profitability even during economic downturns or industry fluctuations. Investors are attracted to business with a track record of sustainable returns and enhancing reputation and attracting new investments. The stability allows for informed decision making regarding investments, expansion, and resource allocation. It also acts as a buffer against unexpected cost or market pressures, reducing the risk of financial constraints. Overall, a stable return on net sales contributes to the long-term success and resilience of a business. For return on equity (ROE), the higher the number, the more money is making for each dollar of investment. Compared to Shoppers, Air Canada has a more stable ROE. However, if it compares to the industry average, the value is not stable. But Shoppers has a higher ROE than Air Canada. It is not hard to see in the graph. The line of the Shoppers is growing very fast. It indicates that the company is becoming more efficient at its ads and generating preferred profits from the shareholders equally. This can result from factors such as the increased profitability, improved operational efficiency, effective capital allocation, or a combination of this. A fast-growing ROE generally signifies positive performance of financial strength and value creation for shareholders. It suggests that the company is effectively utilizing its resources and generating higher returns on investments made by shareholders. It can attract investor confidence, potentially leading to an increase in the company's stock price and overall market value. Return on assets of Air Canada is more stable compared to Shoppers, but from 2020 to 2022, the value of Shoppers is going positive. It indicates that the company is generating higher profits relative to its total assets. This implies improved efficiency and effectiveness in utilizing its assets to generate income. A fast-growing ROA suggests that the company is higher increase in its revenues, reducing costs, or both. It signifies enhanced operational performance and profitability, which can contribute to increased shareholder value. A growing ROI is generally considered a positive indicator of financial strength and effective asset management. The ROI of Air Canada is stable. It means that the company's profitability in relation to its total assets is constant more over time. This indicates that the company is maintaining a steady value of efficiency and effectiveness in generating income from its assets without significant um, fluctuations in performance. And cash flow reasons. Cash flow to current debit is a financial metric that assesses a company's ability to cover its current debit obligations using its operating cash flow. It measures the company's cash flow strength relative to its short-term debt. The average value for Air Canada is 0.31 and for Shoppers 0.26. A higher ratio indicates a healthier financial position and a greater ability to meet debit obligations, so Air Canada is better. Cash flow to total debt is the financial metric that assesses a company's ability to cover its total debt obligations using its operating cash flow. It measures the company's cash flow strength relative to its overall debt burden. Investors, creditors, and analysts often use cash flow to total debt ratio to evaluate a company's financial health and its ability to manage its debit load. A higher ratio indicates a stronger ability to generate cash flow to cover debit obligations, suggesting better debit servicing capacity. The average value of Air Canada is 0.1 and Shoppers 0.13. So Shoppers is higher for this one. Cash return on sales indicates how quickly sales are turned into cash. Advantages of a higher cash return on sales include improved cash flow, enhanced financial stability, and better liquidity, increased investment capacity, and a greater ability to service debt. The average value of Air Canada is negative 0.05 and Shoppers is 0.11. And last one, I think cash flow for share indicates cash flow per share indicates the cash flow generated for each common share. Higher cash flow per share increased shareholders' value and improved earnings per share. It has dividend potential, stronger financial stability, and ability to reinvest the company's growth and strategic in initiatives, and the average value of Air Canada is 0.54 and Shoppers negative 0.22. So from those, we can conclude that the two companies have complementary and equal values. Therefore, they do not have the advantages of beating each other in terms of these values. I mean, for cash flow reasons. And the last part is the conclusion. Air Canada is at a low point right now, but still has a higher ratio than Shoppers. I mean, most of them are higher because the transportation industry is the foundation of all industries. And Shoppers, after all, is part of the pharmaceutical industry and has a stable base year round before the COVID, and is a good choice because of the significant income after the pandemic. Yeah, and